We'll start our discussion. Cost and variance measures. This is the discussion. Broadly, we'll discuss what is a variance analysis, what is a static and flexible budgeting, how we make flexing direct material variance, direct labor variance, mix and yield variances, overhead variance. Comprehensive example we'll do in the last of our discussion to know that we have grabbed the topics, and in the last we will discuss the sale variances. I will start my discussion. What is a standard, what is a budget, and what is a variance? These are three important terms that we should be very clear. We have two units for budgeting. Budgeting is forecasting, looking forward. You predict about 1 year, 2 year or onwards as your organizational needs demands from you. Opposite, we have standard costing, that is based on a rational, experienced observations that what should be a standard cost, standard material, standard labor, which you can determine based on your experiences when you produce some product. So, and variance is in easy English we can say a difference of what we think as a budget. While we were setting the budget, we were foreseeing the next year, next quarter, and when we compare with actual, we saw some differences. These differences are called variances. This is the first thing to start performance management. Being certified management accountants, we are into certain things, and the main thing is performance evaluations. So how we see the performance? First, by using some very nice effective tools of making budgets. Then we start comparing with the actual, and when we feel the differences, we start investigating. These budgets becomes the basis for responsibility centers, responsibility accounting, and everything move around these budgeting and actual results and variance analysis. Variance analysis gives management a tool. It's an effective tool to start looking towards the planning, execution, delivery, and post evaluations. This is a really effective tool, and all financial controllers, CFOs, they are always concerned about variance analysis, because variance shows that there is performance leakage or there is a lack of performance. It may be in planning, it can be because of internal factors, it can be for the external factors. So in this course, our CMA course, we will focus on cost variances, and when we study the costing chapters, you will know that cost is three components. One is material, labor, and overhead. So we'll discuss cost variances, we'll see the labor variances, and we will see the overhead variances. Opposite, we'll see the sales. So sales variances will also be discussed. And if you are working in an accounts department and you are familiar with chart of account, in practical way you can take your chart of account and you can see the budgets, and then you can see the actuals. So you can calculate multiple variances. You can go to any depth of the variances. If you are using Oracle, it has 7-8 levels. Like you can go to the micro level to the macro level variance analysis. We will confine ourselves for cost and sale variances, but for any variance the logic will remain always the same. So when we set variances, first we see the standards. Standards are the criterions. These are the benchmarks that for measuring the performance, and these are budgeted unit cost established to motivate optimal productivity and efficiency. So standard is just not an average of the past. It is a very rational, prudent, practical experience that tells you that how much it should cost. For example, if you're McDonald's, when you sell a burger, based on your past experiences, you can see how much it cost you. So you make that experience as setting the cost through using the standard costing concepts. Standard can be done in two ways. Should we use ideal standards? For example, if you want to do CMA, you are thinking today that you will now study CMA and it will be a full-time study. You will not watch movie, you will not talk to any friend, you will not go for outing, you will not go for out dinners, you will not meet to relatives, and you will just study, even you will not go to the office. This seems practically not possible, because we can focus on CMA with our limited resources. We go office, we need to meet people, we are doing certain jobs. So ideally, if I say I will study 24 hours CMA, that's practically not possible. So there are two ways. One is practical standards and one is ideal standard. In manufacturing, if you have a machine, you are the owner of this machine, and you know this machine is a fixed cost, you have incurred this, and once this machine will run, you will get money out of that, so you will recover your fixed cost. So as a manufacturer, you want to run your machine 24 hours, right? But you have to see that, do you have enough sales? Do you have enough demand for this manufacturing things? If yes, then it's okay, but most of the time it's not. So you will not be able to produce 24 hours, right? So we have to see what is the practicality of the situation. Generally, practical standards work as more effective and efficient, but nevertheless, ideal standards are also important to boost up the morale, motivation of the employees. So you have to see what is the situation, and in that situation we will use these techniques to move forward. We'll start our discussion. The first concept that we have is flexible budget variance. First of all, I should explain you what is the concept of flex. Flex word means that you take your actual quantity and you multiply with the standards. Not quantity, let's do it that you want to compare two things. For example, I make a budget for 1 year and I want to compare it after 1 month. Ideally, I cannot compare 12 months activity with 1 month because it's not logical. So I have to do this flexing, means I have to take the actual quantity and I have to compare with the standards that I set. That is called flexing or flexible budgeting. So if you have one column called actuals, one column called standards, so I need an extra column in between that will be called as flexible budget. That will take actual quantity and a standard price from this side. That is the simple concept. It's not that difficult. It's just flexing. You have to understand. For any kind of variance analysis, we need flexing, because flexing will make things comparable by assuming the actual quantity multiplied with the standard price. This is the same written. It says a flexible budget variance is the difference between the actual results and the budgeted amount for the actual activity levels. Now, a flexible budget consists on the cost that should have been incurred given the actual level of the production. So we take actual and we take the standard and we multiply and we get our flex. For flexing, standard cost should be established.